Yo, what's up? September 1st, everybody. So today, like I said yesterday, today is the normal first of the month big Treasury payments day, probably around 100 billion. I said yesterday we should see, typically on these days, the first of the month, when you get that big positive flow, you see the market react positively. Sometimes it comes the day after, but today we recovered from, again, another day that was looking pretty lousy, but we closed up on the down in the S&P. NASDAQ was down a little bit. So that was the fifth day down for the NASDAQ. Look, we still got September 15th looming out there. And I've been saying that I think that this last week of selling, all right, is part of that anyway. I know there's all this, rate fears, and we had bond yields up again today. And I'm going to show you something at the end of this very interesting about, rates and stocks, where, again, this is another one of these beliefs that people have that was kind of like it's been rammed into their brains and they just react to it without really giving it any consideration or any analysis. It's kind of like, the other things that I talk about. It's like, rates going up, loans are going to go down. I mean, we've seen a 600 billion increase in loans since March, since the Fed has been raising interest rates. And by the way, over that period of time, bank reserves have fallen by 800 billion. Now there's another, belief system that when you actually look at what is happening, I've been telling you guys this and trying to explain it to you, but when you actually look at what is happening, reserves have gone down by 800 billion and loans have gone up by 600 billion. It's been one of the most rapid periods of loan growth since the pandemic. And the pandemic was because the government was basically subsidizing a bunch of loans during the pandemic. I mean, this is happening organically, okay? And, it just shows the inverse correlation between bank reserves and loans. I mean, reserves, I've said this a zillion times, reserves are assets on the bank's books. And, if you have assets, you have to have capital in order to, support or hold those assets. And when you have central banks dumping trillions and trillions of reserves onto bank balance sheets, it doesn't leave much room for loans. So you reduce the reserve balances and boom, we see the loans going up. But the really crazy thing about all this is that you got central banks all over the world who, over the years, we've seen them, engage in this massive quantitative easing. Okay, now it's starting to stop, thankfully. But I mean, they've been engaging in this massive, unprecedented quantitative easing, thinking that, hey, maybe if we just pile more reserves onto these banks, they'll lend them out. When in fact, it's just a hindrance. And, what's idiotic about this whole thing is these central banks are the regulatory, institutions that, tell the banks what to do or control the banks. They basically control the banks. They have, regulatory power over the banks. So you have these central banks who have the whole thing backwards. Anyway, so what was I saying? I'm going to show you something about rate hikes and stocks in a minute. So there's been all these fears. Yeah, there's been all these fears about interest rates going up and, they've been selling the market. I do think, I could be wrong, but I do think that some of this selling, maybe a lot of this selling, is front running of that September 15th, what's going on? that September 15th corporate tax payment, maybe company corporations getting a little bit liquid ahead of that. Plus, like I said the other day, because of the fear that was instilled from the 8-minute Powell speech, I'm going to inflict pain on everybody. Look, people are emotional. They don't understand really. And so maybe they're like, oh, I better get my money ready right now. And the market's going to crash because, he said he's going to inflict pain, and it's better off I raise some cash now. So I think that's part of it. I would put it at a 60-40 probability that is what's happening. So what does that mean? It means around September 15th, when I was originally looking for that big pullback, not big, maybe 5 or 10%, maybe it won't be that much, because maybe that's happening already. We'll see. All right. I could be wrong. That could still happen. But I still think that, we ended the month with a 575 billion leading spending flow for the month. That's good. But we had a 48 billion quarterly interest payment this month, remember. Now, I want to say something, because, these flows, and I call them fiscal flows because in the United States, the U.S. economy, the net spender is the federal government. That's not the case necessarily in other countries, all right? Some countries run surpluses, their governments run surpluses, like Germany, for example. Well, it's not running a surplus now, but they tend to run surpluses, and the other countries of Europe tend to be the net spenders. So somebody, and I gave the example the other day in the mid to late 1990s, when everybody was freaking out about Y2K, the net spenders were corporations that were, upgrading their systems for the change of the millennium. And the Clinton administration started running a surplus. So somebody was net spending. Somebody always has to net spend, okay? It could be, in our case, in the United States, it's the government. Maybe in Japan, it's foreigners, because they run a trade surplus. So foreigners are the net spenders. We are their net spenders because we buy Japanese cars and stuff like that. But the thing I want to say is that is everything else derives from that, okay? Every other economic data point, whether you're talking about, employment, whether you're talking about capital spending, whether you're talking about job growth, I said that employment, whether you're talking about industrial production, whether you're talking about personal income and savings, every other economic data point they're the second derivative of net spending. And again, net spending doesn't necessarily have to be the government. In the case of the United States, it's the government, and we run big deficits here. All right? But it doesn't have to be. But the net spender is the first derivative. That is the key. Every other economic fundamental, if you want to call it that, or every other economic data point is a second derivative. So some people here said, oh, that's all you look at, blah, 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 fiscal flows. That's right, because I look at the core that drives everything, okay? Like if you're in the weather business, meteorology, and you're trying to figure out if there's going to be a hurricane, you have to look at the conditions that create a hurricane. Not, after the hurricane, oh, the wind's blowing at 150 miles an hour and it's moving at 27 miles an hour, east, northeast. No, you look at the conditions that will or will not create the hurricane. That's what I focus on. For me, the reason why I don't look at these other things, like, it's not that I don't look at them, but I already know what they're gonna be. I already know pretty much what GDP growth is gonna look like. I already know pretty much what job growth is gonna look like, or lack of job growth. I already know what capital spending is going to look like. I already know what personal income trends are going to look like because I look at the first derivative, which is the flows. Okay? So if you say to me, Mike, that's all you look at, it's one-dimensional, it's because you don't understand. And that's what every other Wall Street economist looks at, is the second derivative. And that's why they get it wrong all the time, because that has already happened. The conditions to produce that have already been in place. And they're reacting to it late. Okay? They're reacting to it late. Like, it makes no sense to me to look at a data point which is a second, or in some cases a third derivative, all right? Like when the Bureau of Economic Analysis finalizes its GDP, that could be like a year behind. And people will be like, oh yeah, GDP last year was 7%. Oh great, what does that do for me right now? It was last year, it was 7%. No, I want to tell you, or I want to give to myself, what's it going to be in the third quarter, in the fourth quarter, in the first quarter of 2023? Now, if you want to look at data from 30 days ago at best, all right? That's the like for you guys, that's like the most accurate. 30 days ago, I'm 3 months ahead, at least 6 months ahead. So don't say I look at one thing and there's all this other stuff, because all that other stuff is the second derivative or the third derivative or the fourth derivative. Okay, I already know what that's going to be. Got me heated. All right, let's talk about interest rates. It's a very interesting thing for those of you who follow the global markets, and I assume many of you do. And I've spoken about this many times. We've seen countries where, here's another one of these crazy belief systems, but it's like Einstein's, definition of insanity. When something doesn't work, they just keep doing the same thing over and over again, expecting a different result. And one of these cases is Turkey with inflation. The only guy who really had it right was Erdogan, but then he keeps putting in these central bankers that keep raising rates, and they're like, well, why doesn't inflation come down? Because you're setting the price higher and higher and higher. But that's not what I want to talk to you about here today. I want to talk to you about interest rates and stocks. Because interest rates are a flow. All right? Take a look at this chart. This is the chart of the Turkish stock market. Going back to 2000, it is up over 3,000%. And most of that rise has occurred in the last 2 years with these wild, insane rate hikes. Okay? It's gone like a moonshot. Straight up. Rates have not hurt this market. It has boosted this market. It's another one of these just glaring examples of how the belief systems out there are so wrong. But nobody, delves into it because it sounds reasonable on the surface. And when it's been pounded into your head so many times, and you're like, well, what do I know? That's an expert on TV. He's on CNBC saying that to me. Or, he's got 800,000 followers on Twitter. He must know what he's talking about. They don't. Or he's a central banker. He must know what he's talking about. I'm going to inflict pain by giving you more money through the interest channel. Okay, I'll take that pain every day of the week. All right? So, but some of you might be clever and you might say, oh yeah, Mike, but the Turkish lira collapsed. So what's that going to do me? The stocks went up. Yeah, if you're a foreign investor and you translate into the, that currency. But if you're a Turkish resident, citizen or resident, those stocks have helped you keep pace with the purchasing power lost by the idiocy of raising interest rates So stocks for you, if you're in Turkey and you invested, they were a hedge against all that. They didn't take it away. You didn't get a double whammy. You didn't get a loss of purchasing power and your stocks went down. No, stocks are a hedge against that, man. I swear, man, I'm ready to stop this whole thing because it just drives me crazy, man. There's so much ignorance and just like, here's the thing, the worst thing is that people don't want to learn. They don't want to educate themselves. There was some guy on Twitter today made the stupidest statement in the world. He said, MMT says you don't have to tax and you just could spend as much as you want. And that just got me going because, first of all, there is nothing in any of the MMT academic literature that says you don't need to tax. One of the primary bedrock concepts of MMT says that for a sovereign currency issuing nation, taxes are what imparts value to the currency. So there has to be a tax. They don't say it has to be an income tax. MMT has a whole range of different, they said that taxes should be structured in a way to like dissuade or discourage, detrimental types of behavior or economic activity, economic rent seeking, this kind of stuff. But they just come out and say stupid shit like that, like MMT says you don't have, it never says that. Never ever says that, okay? As a matter of fact, MMT does say that taxes can be used as a regulator for inflation. But the bedrock principle, and by the way, again, this is another thing that gets me. MMT is not policy. It is a description of how the monetary system works. All right? Just like physics is a description of how the natural world and the universe works. It's not a thing that you implement. It's an understanding. So yeah, I don't know if I'm going to continue doing it. I might do like a vlog, like a travel video vlog or something like that, or just maybe I'll talk about politics from now on. I'm getting tired of this stuff. I'm going to do my own. Here's the thing. I'm going to do my own investing and I'm going to have my subscribers. And it's not even fair to my subscribers that I keep putting up these things, So I think from now I'm going to switch to maybe politics or something like that. I might lose a lot of people because that's a very divisive, subject. But whatever, whatever. Anyway, that's the update for today, folks. See you tomorrow. Bye.